The United States federal debt stands at over $34 trillion, yet the cost of servicing it, as a percentage of GDP, remains historically low for a major power undergoing fiscal expansion. This is the first contradiction. Standard models predict that a sustained debt-to-GDP ratio above 120% would trigger a market rejection, a sharp, punitive rise in borrowing costs. Japan's debt is over 250% of its GDP, yet its 10-year bond trades near zero, demonstrating that sovereign credit risk is not a function of absolute debt, but of institutional confidence and financial control. The second contradiction is structural. The nation that dictates the global reserve currency should not face insolvency, yet the political incentives driving spending are identical to those that ruined lesser empires. We are watching a collapse not of capacity, but of political will, disguised as a currency crisis. $34 trillion is the number, but the relevant number is the rate of rollover. The system is consuming itself at the sovereign level. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. The collapse is not a single event. It is a slow, numerical decomposition. Let's go back. To understand the seven-stage collapse model, we must first analyze the mechanics of historical sovereign default, which are almost never sudden. The Iberian default cycle provides the foundational template. Between 1557 and 1696, the Spanish Empire, then the world's preeminent military and economic power, declared formal bankruptcy 13 times. The process was not a sudden inability to pay, but a series of structured negotiations. Spain's wealth, fueled by the silver mines of Potosi, was immense, but its spending, primarily on maintaining the Habsburg military presence across Europe, was structurally larger than its revenue flow. In 1556, upon his ascent, King Philip II inherited a debt of 20 million ducats. By 1575, the crown's expenditure was 3 times its ordinary income. The 1575 default was triggered not by an empty treasury, but by the logistics of moving vast amounts of silver from Seville to the Netherlands to pay the army of Flanders. This was the real shift. The mechanics of the 16th century collapse were logistical and political, not purely monetary. The crown repudiated only a portion of its short-term debt and converted the rest into long-term interest-bearing notes, known as juros. This was not a wipeout, it was a forced restructuring. Stage 1 of the collapse model is fiscal expansion without corresponding revenue. The political decision to spend beyond means, relying on future growth. Spain's annual expenditure on war consistently exceeded 70% of its revenue. Stage 2, which followed quickly in the Spanish model, is internal financialization of sovereign debt. The state turns inward, relying on its own population, and primarily its financial intermediaries, to hold its obligations. The Spanish juros, originally a small voluntary issuance, became the primary asset of the Iberian elite. By the 17th century, the state was essentially borrowing from itself. This reliance creates a powerful domestic lobby, where the financial class's stability becomes inseparable from the state's solvency. The risk is privatized, then structural. Confidence became currency. The system is stable as long as the domestic financial institutions believe the state will protect their assets. The numbers told a different story. The perpetual juros effectively paid for a perpetual war. The transition to stage 3, currency debasement and capital controls, is the state's attempt to resolve the structural imbalance without political pain. The Roman Empire offers a parallel, centuries earlier, where the silver content of the denarius fell from approximately 98% under Augustus to less than 5% by the reign of Gallienus in the 3rd century AD. This was not a technological failure. It was a calculated fiscal response to military spending and political appeasement. The state literally reduced its obligation by reducing the intrinsic value of its currency. In the modern fiat system, this is achieved through inflation, which is a default on the purchasing power of the currency. The Soviet Union's final years, though a different economic structure, illustrate this dynamic. By the late 1980s, the official exchange rate of the ruble was meaningless, while the black market rate implied a 90% depreciation. The actual collapse of the USSR was stage 5, the inability to procure necessary foreign currency to service import contracts, which caused a cascade of supply shortages. Stage 4 is the crucial stage, loss of international confidence and dependence on external refinancing. The borrowing shifts from voluntary to necessary. The state must now court foreign creditors, the Genoese bankers for Spain, or the IMF's World Bank for modern emerging markets, at higher, more punitive interest rates. For Spain, the periodic defaults eroded trust, forcing them to issue debt at steep discounts, effectively paying a higher rate of interest than the stated coupon. By 1647, the Crown was routinely paying 30-40% effective interest for short-term loans. This exponentially accelerates the debt servicing costs. The external financing is a mechanism for solvency, not stability. The state trades autonomy for liquidity. The model escalates when the state can no longer rely on external creditors, leading to stage 5, systemic liquidity crisis and rollover failure. This is the point of no return. The state is unable to issue new debt at any price to pay off maturing debt. The 1998 Russian financial crisis, triggered by a collapse in commodity prices, and the Asian financial crisis, saw Russia default on its domestic GKO bonds. Debt to GDP was relatively low, around 50%, but the crisis was one of liquidity and maturity mismatch. The state could not roll over its short-term debt, and foreign capital fled. This failure to refinance is a sudden stop. The state loses market access. Stage 6, institutional insolvency and political fragmentation, is the consequence of the rollover failure. The state must now cannibalize its domestic institutions. Pensions are seized, banks are nationalized to absorb bad debt, and capital controls are enacted to prevent the flight of domestic savings. Spain, post-1596 default, began selling titles and public offices to raise immediate cash, monetizing institutional power. This degrades the very structure of the state. The political system begins to fracture under the strain of resource allocation. The final stage, stage 7, is formal debt repudiation or hyperinflationary cleansing. The two outcomes are functionally identical in their destruction of financial claims. Either the state formally defaults, wiping out the paper wealth of its creditors, or it prints money until the debt is inflated away, transferring the cost to the entire populace through a loss of purchasing power. The Weimar Republic's hyperinflation in 1923, reaching $4.2 trillion marks to the dollar, cleared the domestic debt burden at the cost of destroying the German middle class's savings and political stability. The 7 stages are a logical sequence, not a speculative forecast. They are driven by the mathematics of debt and the political incentive to defer costs. The transition into the modern mechanics of sovereign solvency requires a colder, sharper institutional analysis. The U.S. financial structure, and indeed the entire developed world, is currently operating deep within stage 1 and exhibiting the initial symptoms of stage 5, paradoxically. The U.S. national debt is not simply $34 trillion. It is projected to grow by an average of $1.5 trillion per year over the next decade. The Congressional Budget Office projects that net interest payments alone will reach $1.4 trillion annually by 2033, surpassing the entire defense budget. This scale of fiscal expansion without corresponding revenue, stage 1, is no longer a policy choice. It is an arithmetic constraint. The central mechanism sustaining this is the liquidity dependency of the global financial system in the U.S. Treasury securities. The Treasury market is the foundation of the $80 trillion global carry trade. Money market funds, central bank reserves, and interbank lending all rely on the T-Gaulos bill as the pristine, risk-free asset. This institutional incentive, the belief that the option must be Treasury debt, which prevents the market from enforcing discipline. The illusion holds until it doesn't. The global financial system is structurally invested in U.S. solvency, not because of fiscal prudence, but because the alternative is a systemic collapse of collateral. Consider the role of the Federal Reserve. The central bank acts as the sovereign's buyer of last resort, primarily during moments of acute liquidity stress. Post-2008, the Fed's balance sheet expanded to absorb vast quantities of Treasury and mortgage-backed securities, providing a backstop to both the credit and sovereign debt markets. This is stage 2, the internal financialization of sovereign debt, where the debt is absorbed by the state's own financial arm. Quantitative easing, QE, is the modern equivalent of King Philip II converting short-term debt into long-term juros, only executed by a central bank operating outside the immediate political spotlight. The difference is the scale. The Fed's actions distorted the entire domestic yield curve, managing the interest rate the government pays on its own debt. The current escalation to stage 5 is demonstrated by the phenomenon of rollover risk at scale. The average maturity of outstanding U.S. marketable debt is approximately $60 months. This means that a significant portion of the $34 trillion must be refinanced every 5 years, and the short end of the curve, T-bills and notes, rolls over constantly. In 2024 alone, over $7.6 trillion in Treasury debt needs to be refinanced. This enormous quarterly supply puts systemic stress on the private market's absorption capacity, especially when the Fed is not actively purchasing. Markets enforce what politics avoids. A marginal shift in demand, perhaps China reducing its holdings by just $100 billion, can force yields significantly higher, exponentially increasing the interest cost on the entire pool of refinanced debt. Greece, in the Eurozone crisis of 2010-2012, experienced a sudden and brutal stage 5. Its debt to GDP was approximately 158%. The market's confidence in its ability to refinance collapsed. Private creditors refused to roll over maturing debt. The consequence was an immediate loss of market access and a dependence on the Troika, IMF, European Commission, ECB, for continuous punitive bailouts. The difference between Greece and the US is the ability to print the reserve currency. But even the reserve currency status is a confidence loop. If 25% dollars of global foreign exchange reserves, currently held in dollars, suddenly began to seek alternatives, the US would face a liquidity shock far exceeding any previous crisis. Confidence decides who survives. Japan provides the ultimate case study in extended stage 2, where the state is internally financed to an extreme degree. With a debt-to-GDP ratio exceeding 250%, Japan's government has avoided a rollover crisis because 90% of its government bonds, JGBs, are held domestically, with the Bank of Japan alone holding over 50% of the outstanding total. This is maximum internal financialization. But this stability is maintained only through explicit, continuous yield curve control, YCC, where the Bank of Japan commits to unlimited bond purchases to cap the $10-year yield near zero. This is a perpetual debt monetization strategy that acts as a hidden stage 3, a sustained currency. Debasement through suppressed interest rates that punishes savers. What cannot be repaid will be rolled over. The US is not there yet. But the political addiction to unfunded spending and the Fed's history of intervention mean the institutional architecture for extreme internal financialization is already fully operational. Stage 3 of the financial decomposition model, currency debasement and capital controls, is the inevitable escape route for a sovereign already entrenched in stages 1 and 2. For the US, currency debasement is not enacted through stamping less silver into a coin. It is executed through inflation targeting and fiscal dominance. Inflation, particularly sustained inflation, is a non-legislated tax on the entire monetary base. When the inflation rate is $3% and the federal debt is $34 trillion, the state is effectively inflating away $1.12 trillion of its debt obligation annually. This is a direct transfer of wealth from creditors and savers to the debtor, the state. This mechanism is central to the political stability of an over-indebted state, because it allows politicians to continue spending without incurring the immediate public anger of raising taxes or cutting spending. The current system exhibits institutional incentives for this outcome. Since the 2008 crisis, the Federal Reserve has operated under a dual mandate that, in practice, has prioritized maximizing employment and moderating long-term interest rates. The suppression of long-term yields through market intervention or forward guidance is a direct policy choice that subsidizes sovereign debt. The state becomes addicted to low rates. Any attempt to raise interest rates to a level that truly punishes inflation immediately forces the Treasury's borrowing costs skyward, accelerating the transition into stage 5. The conflict is simple: fight inflation and risk a liquidity crisis for the Treasury, or suppress rates and institutionalize stage 3. China's current real estate crisis and its management of local government debt highlight another facet of the modern collapse mechanism, which feeds into U.S. structural risk. Local government financing vehicles, LGFVs, in China accumulated an estimated $9 trillion in off-balance sheet debt. When the property market froze, the LGFVs could not service their obligations. The central government response has been a structured, opaque bailout, essentially forcing state-owned banks to roll over and absorb the losses. This is state-directed financial triage, a controlled institutional insolvency, stage 6, designed to prevent political fragmentation, also stage 6. The difference in the U.S. is that this institutional insolvency is primarily experienced through pension funds and insurance companies that are structurally required to hold U.S. Treasury debt and are now dealing with suppressed yields and inflation-eroded returns. The structural cost is dispersed, not concentrated. The ultimate signpost that the U.S. is moving into stage 5 is the increasing political brinkmanship over the debt ceiling. While often framed as a political crisis, the debt ceiling fight is a recurring public admission of stage 1 failure and a precursor to stage 5. The repeated reliance on extraordinary measures to manage the flow of funds is an indicator of structural illiquidity, even if the illiquidity is self-imposed. When Congress authorizes an increase in the debt ceiling at the last moment, it is not an act of fiscal responsibility. It is an enforcement of the rollover, a political mandate to avoid the liquidity crisis of stage 5. The final stage, stage 7, is often misinterpreted as a chaotic event. The U.S. will not experience a Greek-style formal default. The political and institutional costs of that are too high. Instead, the final cleansing will be a hyperinflationary one, a sustained period of monetary debasement necessary to inflate away the $34 trillion debt and the estimated $100 trillion in unfunded liabilities for Social Security and Medicare. This is the path of least political resistance. Argentina has, in its modern history, consistently resorted to this mechanism, cycling through periods of high inflation and currency replacement to wipe the slate clean, only to restart the cycle of fiscal expansion. Their inflation rate frequently exceeds $100% annually. The U.S. reserve currency status buys time, but time only compounds the principal of the debt. The mathematics remain. The debt is $34 trillion, the unfunded liabilities are $100 trillion, and the political incentive is to defer cost. The endgame is not a default on the bond principle, but a default on the purchasing power of the dollar itself. The U.S. is currently operating at an accelerated stage 2. The institutional architecture for Stage 3 is in place, and the recurrent debt ceiling crisis is a systemic rehearsal for Stage 5. The collapse is not a single event. It is a mathematical certainty disguised as political gridlock. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.